There's a quiet lie sitting at the center of modern retirement advice. It doesn't scream, it doesn't look dangerous. In fact, it often comes dressed as guidance, responsible, even helpful. It tells you that exciting strategies, complex moves, and chasing the next big thing is what will save your retirement. And millions of people believe it because it sounds like effort. It sounds like doing something. But here's what nobody tells you. The strategy that actually works, the one that quietly builds wealth decade after decade, the one that lets people sleep through market crashes without checking their accounts, it's boring. It's so boring, in fact, that financial media barely talks about it. There's no thrill in it, no headlines, no drama, and that's exactly why it works. I want to walk you through this today, because if you're somewhere between 55 and 70, this might be the most important shift you can make in how you think about your money. Not what to buy, not what to sell, but how to think about the whole picture. Because the difference between a stressful retirement and a peaceful one often comes down to one decision, and it's not the one you'd expect. Let me tell you about two people I know. We'll call them Patricia and Ruth. Both retired around the same time. Both worked hard their whole lives. Both wanted the same thing, peace of mind in their later years. But the way they got there, or didn't, tells you everything you need to know about why boring wins. Patricia spent her career as a nurse. 38 years in hospitals, long shifts, holidays, weekends. She managed to save about $310,000 by the time she retired at 65. She also had a small pension from her hospital system, around $1,400 a month, and her Social Security benefit was about $2,100 a month. She lives in a modest house she paid off 3 years before retiring. Ruth, on the other hand, had a very different path. She worked in marketing, climbed the ladder, made good money. By the time she retired at 62, she had saved nearly $890,000. No pension. She took Social Security early, which gave her about $1,750 a month. She lives in a beautiful condo in the city, with a mortgage she's still paying down. Now, on paper, who looks better off? Most people would say Ruth, hands down. Almost $1 million saved. A successful career, a nice place to live. But here's where things get interesting, because what looks good on paper and what feels good in real life are two very different things. The statement doesn't tell the whole story. It never does. Patricia wakes up most mornings without checking the markets. She doesn't even know what the S&P did yesterday. Her income covers her expenses with a little left over each month. When the market dropped 20% last year, she didn't flinch. She didn't sell anything. She didn't change her life. She just kept living. That kind of calm is its own kind of wealth. Ruth, meanwhile, checks her accounts almost daily. Every time the market dips, she feels it in her chest. She's pulled back on travel, even though that was supposed to be her big retirement dream. She second-guesses every purchase. She has more money than Patricia, but she carries more fear. And that fear is exhausting. It's the kind of weight you can't really put down. So what's actually different here? It's not the dollar amount. It's the structure. Patricia built her retirement around guaranteed income that shows up no matter what the market does. Ruth built hers around a big number she has to manage, protect, and watch every single day. One is boring, the other is exciting. Guess which one sleeps better? By the way, if you're finding this helpful, the subscribe button lives right down there, and I promise I only make videos worth watching. Let me give you an analogy that might help this click. Think of it this way. Your income floor is like the foundation of your house. Strong, underground, invisible, but holding everything up. Your savings? That's more like the furniture. The furniture is nice. The furniture matters. But if your foundation is weak, no amount of beautiful furniture will save the house when the ground starts shifting. Most people spend their entire working lives obsessing over the furniture. They want bigger numbers, better returns, fancier accounts. And they forget to check the foundation. Then they hit retirement, and suddenly the ground starts moving. Markets dip. Inflation creeps in. Healthcare costs rise. And they realize the furniture can't hold them up. It was never meant to. This is the quiet trap of modern retirement advice. It teaches you to chase the number, the million, the 2 million, the magic figure that's supposed to make everything okay. But the number is the furniture. The number doesn't pay your bills. Income pays your bills. And income is the foundation almost nobody is taught to build first. Here's what I mean by boring. The boring strategy isn't about picking the perfect stock. It's not about timing the market. It's not about finding that one investment that explodes. The boring strategy is simpler, and that's why it scares people. It says build your income first, then let the rest grow in the background. Slow, steady, predictable. What does that actually look like? It looks like understanding what your Social Security will be and timing it to maximize the lifetime value, not just the early payout. It looks like treating any pension you have, even a small one, as a serious asset, not an afterthought. It looks like covering your fixed expenses with guaranteed income before you even think about the stock market. The real question isn't how much have I saved, it's how much income do I have showing up every month for the rest of my life. Because if your income covers your needs, the savings becomes a bonus, a buffer, a tool for the things you want, not the things you need. That's a completely different way to live. That's the kind of shift that changes everything. Let me ask you something. Do you know what your monthly income will actually look like when you retire? Be honest with yourself. Most people can tell you their account balance to the dollar, but they have no idea what their actual monthly income will be. That's backwards. The balance is interesting. The income is everything. Now let's talk about Social Security, because this is where the boring strategy really starts to shine. Most people take Social Security as soon as they can, at 62. They want the money. They've waited their whole lives. It feels like the responsible thing to do. Grab it while you can. But here's where the boring math gets interesting. If you take Social Security at 62, you get a permanently reduced benefit, sometimes 25 to 30% less than if you waited until your full retirement age. And if you wait until 70, your benefit grows by about 8% every year you delay past full retirement age. That's a guaranteed 8% return, with no market risk, no fees, no volatility. There's nothing else like it in the financial world. Think of your benefit like a faucet. Behind that faucet is a pipe, one you've been filling your entire working life. Every paycheck, every tax contribution, it all builds pressure in that pipe. And when you turn the faucet on early, you get a smaller, slower stream. But if you let the pressure build, the flow becomes stronger, steadier, and it lasts the rest of your life. Now, I'm not saying everyone should wait until 70. That's not the point. The point is that this decision deserves real thought. It deserves math. It deserves a conversation about your health, your other income sources, your spouse, your goals. It's not a default. It's a strategy. And too many people treat it like a default because nobody told them otherwise. Think about that for a second. One decision, made at one moment in time, often without much research, sets the income for the rest of your life. It echoes for 30 years. It shapes your spouse's future. It determines how much margin you'll have when costs rise. And yet most people spend more time researching a new television than they do this single irreversible choice. That has to change. Here's another quiet thing nobody talks about enough. Inflation. Inflation is like an ice cube in the sun. It doesn't melt all at once. It creeps, it nudges, it slowly raises the cost of everything around you. Your groceries, your insurance, your healthcare. And over a 25 or 30-year retirement, that ice cube can melt your purchasing power down to almost nothing if you're not careful. This is why the boring strategy matters so much. Social Security has a built-in cost of living adjustment called COLA. It rises with inflation. Most pensions do not. Most of your savings sitting in cash or low-yield accounts do not. So the more of your retirement income that comes from inflation-protected sources, the more your future self will thank you. Quick pause. If you're new here, hit subscribe. I've got a lot more of these waiting for you. Let's go back to Patricia for a moment. When inflation hit hard a couple years ago, her Social Security adjusted. Her benefit went up, her pension stayed flat, but her biggest income source grew with the cost of living. So her overall income kept pace with her expenses. She didn't have to change her lifestyle. She didn't have to cut back on the small joys that made her days feel full. Ruth, meanwhile, had taken her Social Security early at a lower base. So her COLA adjustments were applied to a smaller number. Her savings weren't earning enough to keep up with rising prices. She started withdrawing more each month just to maintain her lifestyle. And every withdrawal during a down market locked in losses she couldn't recover from. The math quietly turned against her, month by month. This is something called sequence of returns risk, and it's the silent killer of retirement plans. It means the order of your investment returns matters just as much as the average. If you retire and the market drops in the first few years, and you're pulling money out, you're selling low, you're locking in losses, and your portfolio may never recover, even if the market eventually rebounds. The boring strategy protects you from this. When your fixed expenses are covered by guaranteed income, you don't need to sell investments during a downturn. You can let the market recover on its own time. You're not forced into bad decisions because the bills are already handled. That's the quiet power of an income floor. It buys you something more valuable than returns. It buys you patience. Now let me ask you something. Have you ever calculated what your pension is actually worth in real dollars? Most people never do. If you have a pension, even a small one, sit down and do this math. A pension of $1,500 a month, for example, is the equivalent of having about $450,000 in savings that pays you 4% forever, with no market risk. That's not small, that's massive. And most people treat it like an afterthought. Same with Social Security. If your benefit is going to be $2,500 a month, That's roughly equivalent to having $750,000 in the bank generating safe income, but with the bonus of inflation adjustments. So before you stress about your savings number, look at what you already have. You may already have what people with millions are searching for. This is the reframe that changes everything. The wealthy retiree isn't always the one with the biggest portfolio. Often, it's the one with the most predictable income, the one whose expenses are quietly covered before they even check their accounts, the one who can afford to ignore the market because the market doesn't determine their lifestyle. That's real wealth, and it doesn't always look like wealth from the outside. Now, I want to be honest with you here. The boring strategy isn't sexy. It won't make you rich quickly. It won't give you bragging rights at dinner parties. Nobody's going to write headlines about how you methodically built a stable income floor and let your investments grow slowly in the background. But your future self, your 75-year-old self, your 85-year-old self, will be deeply grateful. They'll thank you in ways you can't see yet. Let me give you another way to think about it. Imagine your retirement in two parts, not one big number, two distinct piles. Pile 1 is income that shows up no matter what. Social Security, pension, maybe an annuity if it fits your situation. This pile is for needs, your housing, your food, your healthcare, your utilities. Pile 2 is your savings. This pile is for wants, travel, gifts, hobbies, the things that make life rich. When these two piles are properly built, something amazing happens. Market volatility becomes background noise. A 30% drop in your portfolio doesn't change your life because your needs are covered by pile 1. You might delay a vacation, you might skip a big purchase, but you don't panic. You don't sell, you don't lose sleep. The drop becomes news, not crisis. Compare that to the person who has everything in pile 2, all savings, all market-based, all dependent on returns. When the market drops, their needs are at risk. Their housing, their food, their healthcare, all of it is tied to portfolio performance. That's not retirement. That's a 30-year stress test, and nobody enjoys their 70s and 80s living through that. Here's a question. If you had to choose between more money or more certainty, which would it be? Keep that in your head as we go, because the answer to that question shapes everything about how you build your retirement. And most people have never been asked it directly. They've been sold the idea that more money is the only goal. But certainty, real certainty, is a different kind of currency entirely. Now let's talk about something most retirement planners gloss over: the spouse. If you're married, your retirement plan isn't really about you. It's about both of you, and it's about whichever one of you lives longer. Because at some point, statistically speaking, one of you will be alone. And the question becomes, will that person be financially okay? This is where the boring strategy really proves its worth. If you delay Social Security to maximize your benefit and you're the higher earner, that bigger benefit becomes the survivor benefit for your spouse. It carries on after you're gone. If you took Social Security early, you locked in a smaller survivor benefit forever. That's a decision that echoes for decades. Same with pensions. Many pensions offer survivor options, where you take a slightly smaller monthly amount in exchange for guaranteed income to your spouse if you pass away first. Most people pick the higher payment without thinking it through. And then later, when one spouse is gone, the surviving spouse is left with reduced Social Security and no pension. That's a financial cliff, and it catches people completely off guard. This is why the boring conversation, the one nobody wants to have, the one about what happens if I die first, is one of the most important conversations a married couple can have before retirement. Not the romantic version, the practical version, the one with numbers, with scenarios, with backup plans. It's not pessimism, it's realism. And in this case, realism isn't negative, it's empowering. Let me tell you what Patricia did, the nurse from earlier. When she retired, she sat down with her husband and ran the numbers two ways. What does our income look like if he passes first? What does it look like if she passes first? And then they made decisions based on whichever scenario looked weaker. They strengthened the weak side. That's how you protect a marriage with money. That's the boring genius. Now let's get into expenses, because this is where so many retirement plans quietly fall apart. Most people dramatically underestimate what they'll actually spend in retirement. They think their costs will go down because they're not commuting or buying work clothes. And some costs do go down, but others, the ones that creep in slowly, go up in ways people don't expect. Healthcare is the big one. Medicare doesn't cover everything. There are premiums, supplemental plans, prescriptions, dental, vision, hearing, and the costs that come with aging, in-home help, possibly long-term care. These expenses can grow significantly in your 70s and 80s, exactly when your savings are supposed to be holding up. If you didn't plan for this, it can hit hard. Then there's the lifestyle creep that goes the other way. When people retire, they suddenly have time. Time to travel, time for hobbies, time to spoil grandkids, time to eat out more, time for projects around the house. These things cost money, and many retirees find that their first few years of retirement are actually more expensive than their last years of working. That's not a problem if you planned for it, but most people don't. So here's the practical move. Sit down and build a realistic monthly expense budget for retirement. Not what you think you'll spend, what you actually spend now, plus what you know will change. Healthcare goes up. Mortgage might go down if you pay it off. Travel might increase early on. Gifts and grandkid expenses tend to grow over time. Be honest, be detailed, be a little pessimistic just to give yourself a cushion. Then compare that number to your guaranteed income. Not your total savings, just your guaranteed income, Social Security, pension, any annuities. If your guaranteed income covers your needs, you're in incredible shape, no matter what your savings number is. If there's a gap, that's where your savings and any other strategies come in to fill it. The goal is simple, but the strategy to get there is anything but flashy. The goal is to have your needs covered by income that doesn't depend on the market, and your wants funded by savings that can grow over time. That's the boring strategy. And it's the strategy that lets people enjoy their retirement instead of just surviving it. If you've gotten value from videos like this before, you know the subscribe button is right there. Consider it your investment in future videos. Let me ask you something personal. Have you ever avoided opening your retirement statements because you were afraid of what you'd see? You're not alone. This is incredibly common, and it's a sign that something needs to change, not the numbers. Your relationship with the numbers, because avoidance is the enemy of clarity, and clarity is the only thing that brings peace. Let me show you what I mean. When Patricia checks her accounts, she's not looking for growth. She's looking for stability. She knows her income is set, the accounts are extra. So whether they go up 10% or down 10%, her life doesn't change. That removes the emotional weight. The accounts are just numbers. They don't define her. When Ruth checks her accounts, every number is loaded. Every dip feels like a threat. Every gain feels like temporary relief, because she's relying on those accounts to do the work that income was supposed to do. She made the accounts her foundation, and now she can't stop watching them. That's the difference between owning your investments and being owned by them. Now, I want to talk about the big number myth, because this might be the single most damaging idea in retirement planning today. You've heard it. You need $1 million to retire, or $2 million, or some massive figure that makes most people feel hopelessly behind. And when people hear that, they panic, they freeze, or they give up. None of those reactions are useful. Here's the truth that almost nobody says out loud. The majority of retirees in this country don't have anywhere close to $1 million saved, not even close. And yet, most of them report being satisfied with their retirement. How is that possible? Because the big number isn't actually the variable that determines satisfaction. Income is, lifestyle fit is, health is, relationships are. The big number myth quietly damages people in two ways. First, it makes people who have less feel hopeless, when they might actually be just fine. Second, it makes people who have more feel anxious, because they're chasing a target instead of building a life. Either way, the number wins and the person loses. That's the silent cost of bad advice repeated too many times. The real question isn't, do I have enough? It's, does my income cover my life? That's a completely different question, with a completely different answer. And it's a question you can actually answer with real math, not vague fears. You can sit down today on a piece of paper and start to see the truth of your situation. That's where peace starts. I want to pause here and say something important. If you're listening to this and feeling a little behind, a little anxious, a little unsure, that's okay. That feeling doesn't mean you failed. It often means you've been measuring the wrong thing for too long. The moment you switch from chasing a number to building an income, the whole picture starts to look different, lighter, clearer, more possible. So how do you actually build this boring, beautiful retirement? Let me give you a simple framework. 5 steps, nothing fancy, but they will change how you approach this if you take them seriously. Read them, write them down, put them on your fridge if you have to. Because doing them, even slowly, is what separates the people who feel peaceful from the people who feel trapped. Step 1, get clear on your real monthly expenses, not your guess, your actual numbers. Pull 3 months of bank statements. Categorize everything. Add a buffer for healthcare and inflation. This is your number. Without this, nothing else makes sense. Everything you do from here builds on this one piece of information. Step 2, calculate your guaranteed income. Add up your projected Social Security, any pensions, any annuities. Look at the timing. Run different scenarios, claiming at 62, 67, 70. See how those numbers change. This is your foundation, and when you see it on paper, you'll be surprised how much steady ground you may already be standing on. Step 3. Identify the gap between guaranteed income and real expenses. If there's a gap, that's the work your savings has to do, not your whole life, just the gap. This shrinks the problem dramatically for most people, and it shows you the actual size of the challenge. Suddenly, the mountain becomes a hill, and the hill is something you can actually climb. Step 4. Structure your savings to cover the gap safely. The closer that money is to needing to be spent, the safer it should be. The further out it is, the more it can grow. This is the boring part. It's not exciting, but it's how you avoid sequence of returns risk and other quiet dangers. It's the discipline that keeps the foundation from cracking. Step 5. Plan for both spouses. Run the numbers for each scenario. Strengthen the weaker side. Make Social Security claiming decisions with the survivor in mind. Choose pension options with the survivor in mind. Have the hard conversations now, while you have time and clarity to make good choices. Your future selves, both of you, will be glad you did. That's it. That's the strategy. It won't go viral. It won't be in a magazine. It won't trend on social media. But it will change your retirement, your sleep, your marriage, and your peace of mind. And it will let you spend your 70s and 80s enjoying your life instead of managing your fear. That's not a small thing. That's everything. I want to leave you with this. There are people with millions of dollars who don't feel secure. And there are people with modest savings who sleep soundly every night. The difference isn't the number. The difference is understanding. Understanding your income, understanding your expenses, understanding what actually matters. That's the difference between stress and peace. Stop measuring yourself against everyone else. Start focusing on what truly gives you freedom. Because freedom in retirement doesn't come from a big number on a statement. It comes from knowing that the money showing up every month is enough for the life you actually want to live. And that's a feeling no headline can give you. You have to build it, quietly, patiently, one boring decision at a time. If this video made you think differently about your retirement, subscribe. The next one goes even deeper. I'll see you there.